Hello, everyone, and welcome to this special all-mailbag edition of The Final Bar. I'm your host, Dave Keller. I'm the Chief Market Strategist here at StochCharts.com in a sunny Redmond, Washington. Thanks for joining us every weekday after the close as we break down the market action using the best practices of technical analysis. Today, we're going to answer some of the thoughtful questions we've received in our Final Bar mailbag here over the last week or so. As a reminder, these episodes are all fueled from people like you sending in questions as you are analyzing the markets using technical analysis and the StochCharts platform. So make sure you email us your questions at thefinalbar@StochCharts.com. With that in mind, let's get to question number one. The Stochastics RSI or the StochRSI and Stochastics Oscillator. Those two indicators seem almost identical. How and when should I use them? It's a really good question, actually, by the way. And to be honest with you, I have found that there are a lot of oscillators like RSI, Stochastics, StochRSI, the Williams Percent R, the Commodity Channel Index, all very, very similar. And by the way, I appreciate you sending in your chart along with it. This is the chart that you sent in. So as a reminder, those of you sending in questions for the next mailbag episode, below the chart on Sharp Charts, there's this little link. What you want to do is copy that hyperlink, include it in your question, then I can actually see a live version of the chart you're looking at. In ACP, in the lower left corner, there's a similar little icon with a chain link. If you click on that, or it might be an arrow actually in ACP, you can share that link as well. So a helpful way to just sort of see what you're looking at. So you're looking at Canadian Natural Resources, which is a Canadian energy stock. And here are the two indicators you're asking about, StochRSI and then the full stochastics. So here's the thing, right? With all these indicators, they are very, very similar. And I would say one of the issues I run into when I find when people are just learning technical analysis, they go a little bit indicator crazy. So they are looking at a set of indicators and then they are looking at a group of indicators and they have multiple indicators that are very similar. So my first answer would be looking at both of these is definitely not the right answer, right? I mean, to be honest with you, what you want to do is find one oscillator and use it consistently. So I use RSI because that's what I've had the most experience with. I've found it jives very well with my mindset. I like the multiple timeframes analysis that I can draw out of the patterns in the RSI. So I go with that. But for you, if you're on if you're a swing trader as opposed to a position trader, maybe one of these indicators ends up being more meaningful. So to specifically answer your question, stochastics is literally looking at over a period of time, in this case, a 14-day period, where are we at relative to the highest high and lowest low over that period, right? So if the stochastics was at positive 100, that would be literally we're at the highest point for the last 14 days. A stochastics of 0 would be we're at the lowest point for the last 14 days. But we're smoothing that out by 3 days, which is why you never really see it go to 0 or 100 because we're looking at an average over 3 days. Then you smooth that out by another 3-day period, and that's the red, what you call the signal line probably. And you're looking at when they flip over and above and below each other. This indicator called StochRSI literally combines the stochastics and RSI. So this is the indicator RSI that I have on all my charts. Different stock here. I'm looking at Squarespace, but that's the indicator that I use. So StochRSI actually applies this stochastics formula instead of to the price action. It actually applies it to the RSI values themselves. And this is an indicator. I think it was Tushar Chand that originally created this. Maybe it was someone else. And the idea was to apply a technical indicator to another indicator. So it's looking at the range in the RSI and seeing when the RSI is at a high or low level relative to one another. I would encourage you to read the Chart School articles on stochastics, on RSI, and the StochRSI. Just type in that text into the little magnifying glass here in the upper right, or where it says help, and you will find more information about those different indicators, how they relate, how the formulas are subtly different. All I would answer, I guess my main answer would be they are very similar and the calculations are different, but they're all based on price momentum, right? All of those indicators that I mentioned at the beginning of this question, all based on the same price momentum. They're just subtle differences. So using multiple indicators like RSI, stochastics, and StochRSI is overkill. Pick one that you find the signals jive very well with your trading approach and use those consistently. Also remember the periods that you use are going to make some subtle differences as well. So you can customize all those indicators to better fit the signals that you are looking for. Question number 2, you recently showed a chart of Tesla with lots of relative comparisons. How can I create a chart like that? So don't feel bad. And to be honest with you, the way you learn it, number one, I'll show you how to build it from scratch. But the real way you learn it, and in the description below, or in the first comment below, we'll include a link to the chart that I'm about to show you, so you can copy it to your own login. But this is actually a Gaddis Rose chart. He sent this to me a long time ago, and I've adapted different versions of this. I don't know if this is the exact one that you included in your question, but this is pretty similar. This idea of the Gaddis's approach, which is focusing on relative strength on different buckets of stocks. So I'm looking at Squarespace. This is just the stock that I had up. And so the top section has 4 different relative comparisons. Now, at the bottom of all of my charts, my normal charts, I have relative strength of Squarespace versus the SPY. Grayson Rose, frequently on the channel here, does it relative to VTI. And I think, honestly, either of them are great. I'd pick one and do it consistently. Gaddis's approach is to look at multiple relative strength comparisons for different groups of stocks. So here's Squarespace versus the broad market. So this is versus VTI. This is Squarespace's sector, technology versus the broad market. So I can see whether the sector is doing better or worse than the broad market environment. Here's Squarespace's group, which is software versus the technology sector. So is its group doing better or worse than the broad sector? And then this is Squarespace versus its industry group. So is this individual name a leader within that group? So top to bottom, you can see that Squarespace has been outperforming the S&P or the Vanguard Total Market Index year to date. Technology, though, has been underperforming the S&P, and the software group, which includes Microsoft, some other mega cap names as well, has actually not been doing particularly well versus technology year to date, down slightly. But Squarespace is actually doing better. It's actually one of the best names within the software group because it's outperforming its index. So a chart like this, which is breaking out, outperforming its industry group, outperforming the benchmark, pretty good chart. So even though technology is not a particularly strong sector, I think the individual name, you see that it's actually doing much better than the average technology stock. Now, the way that you create that, I would say the easy version is in the first comment below. I have a link to this chart. So click on that. You can save it to your own login and you can get all of this already done for you. But these are the comparisons that we're doing. We're using an indicator called price-performance, and then you use this syntax, $ symbol, $ sector, $ industry. We'll bring up the appropriate information for whatever ticker you run this on. And then if it's hard coded, so I always want to use VTI as the denominator there, you just put in the ticker. Though that's the syntax that you can use to do all sorts of really cool relative comparisons. And again, click on the link in the comment below the video, and you can save that chart to your own StockCharts login. Next question. On your April 29th show, you showed PayPal. Are there multiple patterns at work here? And again, thanks again for sending the link to the chart that you were looking at. Really interesting. And you can see, I see some of your annotations that you put on here. You actually had a very thoughtful and detailed question. So I'll go through some of these points. You indicated you're sort of struggling to determine how to label this in terms of the patterns. So here are your questions. First one is line A, which is this sort of parabola, what we call it, an inverted head and shoulder pattern that had a failed breakout. I would say so, right? Because you see a head here, an inverted head and shoulders, right? You see the higher low in August, the higher low in January. You take the neckline, which would be this point here in September, and this point here. So those are these swing highs between the head and the two shoulders. You draw a trend line there. And then I would say in mid-January, I tell you what, PayPal actually looked pretty constructive because it broke out of that inverted head and shoulders neckline. It broke above the 200-day moving average, which it had not done consistently for quite some time. Pretty encouraging development. But if you look what happened, it failed. And I would argue that that was certainly a valid breakout that just never really followed through, ended up being a failed breakout. So 100% agree that was an inverted head and shoulder pattern. It did complete the pattern, but didn't go much further. Is line B a cup and handle pattern? Now, that's a little more challenging of a question. So first off, I mean, not really. I would probably not label it a cup and handle because you can see there's almost like a larger sort of basing pattern happening here. A cup and handle pattern is usually something you'd see more in an uptrend. Then you see the big cup and the handle. It's more of a continuation pattern. That's what Bill O'Neill at Investors Business Daily who really created and popularized that pattern. That's what he was really looking for, a stock that had a good run. Then the cup and handle was more of a consolidation kind of continuation pattern, and then a breakout was valid. So I don't think I would label that. And also, it's not really a cup and handle needs to have a big rounded bottoming pattern, and this is more of a choppy, noisy kind of pattern. So I probably would not label it. But your point here, is this a handle? No, because it's not a cup and handle in my opinion. Does rectangle C contain a bull flag within an uptrend? That I probably would maybe agree with, which is a big run higher, kind of have this parallel downtrend channel, lower highs, lower lows. We broke out about a week ago. I would say so. So that's how I would answer your questions. To be honest with you, the chart at PayPal still, I feel like, has more to prove, right? And I would put PayPal and Apple in that bucket of stocks that gapped higher over the last week, but never really traded higher, right? Apple gapped higher last Friday and then went, traded lower through the course of the day and really continues to sort of languish below that open. Same with PayPal, opened at 70, hasn't seen that level. It's currently down around in the mid 60s. So that's how I would answer your question. Again, I think with PayPal, the real trick is getting above this resistance, which you've indicated with the blue line on your chart. Next question, the long-term chart of XLB, that's the materials sector, shows a cup with handle indicating a good buy point. Your thoughts? Really interesting question. Not even looking at the chart yet. I would say, yeah, but just because I have the chart in my head, the daily chart kind of shows this recent breakout, the higher low here on 88. But looking at the weekly chart here really shows the magnitude of this break. And I think this is what you're talking about. The energy sector, to be honest with you, looks kind of similar to this. Going into Q2, when I think about sectors that have upside potential on this longer term time frame, materials and energy are probably it. I don't think we've seen the end of the commodity run. I mean, as I've noted, gold has actually outperformed the S&P and the NASDAQ year to date. So material stocks actually have looked quite strong, and not just gold stocks, but other parts of that sector as well. So I would agree that the XLB breaking out of this basing pattern, multi-year basing pattern, is pretty meaningful. I would say materials and energy represent pretty decent opportunities because of that. Trend. Now, you asked if it's a cup and handle pattern. I don't think so. And again, because a cup and handle pattern really should be more of a more of a severe drop and more of a rounded bottoming pattern. I would describe something like this as more of a basing pattern, which is you kind of can draw a rectangle around the price action. It's a consistent resistance level, kind of in that $85 range. But in any case, breaking out above that resistance, I think, is pretty meaningful. I would agree with your assessment there. Next question, do the monthly charts on StochCharts including the data for the full month instead of a standard 4 weeks of data? And you ask, for example, in April, April 1st was a Monday, April 30th was a Tuesday. It spanned about 4 weeks plus a couple days. So you would assume that it would use April 1st through the 30th and not Monday, April 1st through Friday, April 26th. And the short answer is you're correct. The monthly charts, and this is the convention not just on StochCharts, but most charting platforms, and if you ever run into a charting platform that doesn't do this, boy, they are doing it wrong. Because the convention is you consider a monthly candle, you consider the first through the last trading day of that month, that's your monthly bar or candle. So different candles will represent different stretches of time, right? Some months could be 25 trading days, others could be 20 trading days, whatever it is. And so there's a little bit of variability there. But the idea is the end of every month, calendar end of every month is what's most important. So every, the bar that you see or the candle that you see representing the current month on my login, it's highlighted in green. Depending on what data sources you use, it might be highlighted yellow on your login. But in either case, remember, anything's highlighted that means it's an active candle that's actually moving real time. So if materials fluctuates over the next couple of weeks here, as we're in early mid-May, this candle could dramatically change. Last month's candle, of course, ended at the end of April, and so it's not really going to change. But the active candle is going to fluctuate intra-month during the month until the end of the month. And once May 31st has occurred, whatever the last trading day is, that would be your closing value for the monthly candle. That's the convention, and that's what I would certainly suggest you think about. Final question. Not sure what happened with the chart of Door. Can you explain? That's on DoorDash, actually. I initially thought Door, I'm like, what? Now that ticker's Dash. This is actually an industrial name called Masonite International. This is your chart that you sent me, and thanks for including the link. And I think you're referring to this business that happened here. So second week in February, it gapped from like 97 up to about 132 or so, 130, and now it's been sort of flatlining since there. You have found what happens to a chart when there is an M&A deal. This is a company that got bought out, and checked out the news. I don't follow this ticker in particular. This is a mid-cap building materials stock, but it was bought by Owens Corning back in. They announced that in February. So what happens when a company is bought out and it's a public company? You have the initial announcement, and what happens is the stock basically overnight goes from wherever it closed to whatever the buyout value is. So it was valued at like 133, I think, like that. And so it gapped up near that level. And from there has basically been flatlining. The deal has not closed, and because you have to wait for it all to be, to meet regulatory approval. So you have this weird kind of flatline period where the stock really isn't moving much. And these are just kind of little tiny movements. And then it sort of settles in. You can see here where the terms of the deal were kind of finalized. It gapped right to 130, 133 or so. So here it kind of opened around 130 and has been trading around here. And I think that's when they're speculating what the actual value would be. It settled into $133 a share, and from there it hasn't moved much off of that level. So at this point, the stock's basically dead to public trading, although you could technically do it. The reality is that the only reason why this would move from here would be if the deal falls through. And that's, the only benefit, I think, to looking at it at this point is if you're betting on the deal following through and that it would, gap up or lower because of that. And most likely it would gap down in a pretty big way. That's one thing you could do. But charts like this are pretty much done because it's based on the M&A valuation. And unless something tragic happens in terms of the M&A deal following through, this is what the chart is going to look like until it is sunset and probably delisted, or the structure of it will change and it will freely trade again based on the future of Masonite International. I didn't really look at the details about what Owens Corning plans to do with this particular company, but that is what happened. So if you see that gap and then that weird flat line, it means it's a buyout. Look at the news to see what the details are, but usually from a technical perspective, not much to talk about unless the deal would follow through. That's it, folks. Thanks so much for joining us every weekday after the close. Have a fantastic weekend. We should be back to normal programming on Monday. But until then, have a great weekend. Be well, stay safe, and we'll talk to you again soon.